real estate finance. That is what we're doing tonight. We're going to review the content of finance and then go into some questions. Oops, sorry about that. And there are a little bit of internet issue. I'm warning you in advance in case we have interruptions. Okay, so we're going to start. Hopefully, you need to learn or review your finance section and do some questions. And though these are national, finance is for national in the question. So it applies to all 50 states. So let's get started. And I remind you to type in your question number and the letter answer when I'm reviewing questions, and ask questions at any time. If I don't, I'll Google it. Okay, so finance. When do we use finance? Well, mortgage transactions. When buyers are getting loans, they're going to go to a lender. Hey, Max, thanks for joining. They're going to go to a lender, a mortgage broker, a mortgage bank, regular bank. They have multiple reviews. Transaction, the elements are a promissory note, which is a promise to repay the loan. Now, a promissory note is not recorded. Only the deed of trust or the mortgage itself and the warranty deed. About 50% of the states have deed of trust. Others have the mortgage. And the difference is that with a deed of trust, there is an unjudicial foreclosure. If it's a mortgage, it's a judicial foreclosure. They have to go to the court and get the judge's approval, a judgment to start a foreclosure. So mortgage, it is the pledge of property as collateral for the loan. So the property becomes a collateral for that loan until the loan is paid off. So the mechanics of a loan, mortgage. Again, the promissory note is not recorded. The mortgage or deed of trust and the warranty deed are. Lender gives borrower funds and records a lien. So the warranty deed will say who the owner is, and it has a vendor's lien. Once the note is paid off, the mortgage is paid off, then the lender will remove that lien and provide a release of liens. Hypothecation, use of real estate as collateral for a mortgage loan. So as collateral. So the mortgage that they need to pay back as collateral. Hypothecation is the use of the real property as collateral for a mortgage loan. The financial components of a loan financial components. Original principal, capital amount borrowed on which will make a down payment. FHA, Federal Housing Administration, 3.5%. Conventional, it can be as little as 5% or more. And sometimes on a difficult market can be as little as 3% on a conventional loan. FHA, it's 100% finance. So original principal, capital amount borrowed on which interest payments are calculated. The loan balance, remaining unpaid principal at any life of the loan. So these loans are amortized typically for 30 years. So every month that a payment is made, the principal goes down a little bit and the interest is large. So the majority of the payment goes through the principal if there isn't much of a down payment initially when purchased, and the principal reduces a little bit. And then, of course, the taxes and insurance, but that doesn't impact the principal amount of the mortgage. As the years goes on and the amortization schedule, it shows that at a certain point, more money will go towards the principal and less towards the interest. So the interest is charged for the use of money, a rate fixed or variable. And this is one great reason that people love to invest in real estate and then rent it out or sell it on owner financing, because they will be able to deduct the interest of a mortgage and the taxes. It is a tax shelter. There is a lot of benefits for owning real estate. Annual percentage rate, known as the APR. This includes interest and all finance charges lender must disclose on a residential property. So the interest rate is what's the interest rate on the loan. However, the annual percentage rate, they include all finance charges, which increases the the interest rate by a little bit. And so when a borrower gets in, they're like, well, my interest rate is 6%. Why is it 6.125? Well, because they added now the finance charges. And the lender must disclose that on a good faith estimate. That's why it's good for borrowers to compare. 1% of the loan amount, not the sales price, but 1% of the loan amount. So if the loan is $100,000, 1% is what? 1,000. Move the decimal 2 places to the left, 1,000. Loan origination fee. Many banks or lenders will charge a loan origination fee. Not all of them. This is charged by the lender at origination to obtain the required return. They want to make money. Everybody's into this real estate to make money. Very few people that I know aren't. In fact, I don't know any that aren't. Somebody very wealthy, but they still want to make money. So a lot of expenses that go to a borrower and they say, oh my gosh, my closing costs are so high. Well, they could have a point to reduce their interest rate, so they have a better interest rate on a long-term loan. They may have an origination fee. That's another charge. Then they have to pay the interest, 1 year of insurance, and also some property taxes in order for the lender to have an escrow account, a little savings account. So the term of loans, period of time for repayment of interest and principal. Every now and then, people take out loans that are interest only, and that's typically investors. And those are called ARM for the most part. When there's construction, they may have an interest loan and then convert that once the construction is completed to a full-blown loan. So the term of the loan, 30 years. Most people don't stay there 30 years anymore. My family, my older family, the older generation, they would, but not most. So a lot of them would pay their loan off in 30 years. The payment, the periodic payment of interest and or principal. The down payment, borrower's cash payment applied to the purchase price. So for an FHA loan, 3.5%. For conventional loan, it could be as little as 3% or 5%. And conventional loans are not as strict as FHA. Whenever there is less than a 20% down payment, there is going to be property mortgage insurance, PMI, for conventional loans. For FHA, it'll be MIP, mortgage insurance interest, and that's for the life of the FHA loan. Now, the lender also looks at the loan to value ratio, the loan's share of the total value of the property. What is the loan to value ratio? Equity. Equity is how much the borrower has paid down. If they put down 20%, they already have 20% equity. And every month that they pay, their equity increases a little bit until after a whole bunch of years. And then eventually they can borrow on their equity, get an equity line of credit, which is called the HELOC, home equity line of credit. So at closing, the borrower's cash invested in the property. Thereafter, the difference between the market value, the purchase price, and the loan, that is the equity. And that grows the longer they keep that property and that loan. So here's what I was talking about a little bit about the trust deed. Some states have a trust deed. About maybe 50% of the states have a trust deed. Others do not. They have the mortgage. So a trust transaction, the elements of it are A, promissory note. The trustors promise to repay the loan. And who is the trustor? The borrower. The deed of trust is title to the property as collateral for the loan. And the deed of trust is pages long. It explains the process if someone were to default, what happens next. So the trustee is in charge if the borrower defaults to starting a foreclosure process. So there's the trustor, the trustee, and the beneficiary. Whenever there's a trust, there are three parties. Okay, think of trust, three: trustor, trustee, the beneficiary. Beneficiary is the lender or a hard money lender. It could also be. So the mechanics of a trust deed transaction is the trust deed conveys title from the borrower trustor to a third party, and that is the trustee. So the trustee, okay, has the trust deed. So they have the trust deed. It's conveyed from the borrower trustor to a third party. So the trustee is in place for the lender. The trustee holds title on behalf of the lender, beneficiary, until the debt is paid. See, lender, beneficiary, trustee, trustor, the borrower. The promissory note. So what is the promissory note? So the promissory note is the legal instrument executed by borrower stating debt amount, loan term, method and timing of repayment, interest rate, promise to pay, may repeat other provisions from a mortgage document or deed of trust, negotiable instrument assignable to a third party. So in the generations ago, if someone borrowed money from a friend or someone else, they would give them a piece of paper, a promise to pay. I promise to pay you this loan in a week, a month, in a year, and in this type of payments and this frequency. Well, same here. That's what a promissory note is. That's between the lender and the borrower. This is not recorded. Okay, so it is a legal instrument executed by the borrower, right? I promise to pay you, lender, the debt amount in 30 years. And the method that they're going to be using, and principal and interest, right? A fixed rate, and timing of the repayment. How often? The interest rate, 6%. Right now, that's about what it is. Promise to pay, may repeat other provisions from the mortgage document or deed of trust. The mortgage clause. So payment of principal and interest. There could be a prepayment fee or late charges. If somebody is late every month, the lender is going to charge late fees. If they choose to pay the loan early, sometimes a lender will have a prepayment fee for paying it before it's due. The lender wants to make money on their interest. And so I advise my borrowers, don't get a loan that doesn't have a prepayment penalty and it has a fixed interest rate. Variable interest rates get borrowers in trouble, especially those that are inexperienced. Charges. Okay, so what are they? Borrower must make timely payments according to the terms of the note. They will start the foreclosure proceeding according to the state rules. Late payment or early payoffs may trigger penalties. Majority of loans have like a leeway of 5 or 10 days, and it'll specify it on the promissory note. So funds for taxes and insurance. So hazard insurance, homeowners insurance, and that's property taxes. We never own a property 100%. There's always property taxes and homeowners insurance whenever there is a loan. Someone can risk not having insurance after the loan is paid off, but taxes will always be due. The only instance I learned is if someone is 100% disabled, they will be exempt from paying property taxes. So borrower may also have to pay flood insurance and mortgage insurance premiums in the case of an FHA loan. Flood insurance if they're in a flood area. Escrow account, what is that? It's a savings account that the bank has. The title company and the attorney that close transactions, they're called the escrow officer because they hold on to the money and process the whole transaction documentation. But for a lender, the escrow account is to reserve account for periodic payments of taxes and insurance. So the monthly payment will have principal, interest, taxes, and insurance. PITI, P-I-T-I. Not pity like feeling sorry for somebody, but PITI, P-I-T-I. Remember that acronym, principal, interest, taxes, and insurance. And so when closing costs come about, whenever there's a loan, there's high closing costs because the lender is going to require 1 year of homeowners or hazard insurance and at least 2 to 3 months of property taxes to have a little escrow account, little savings account to pay them when they are due. Now, every year the lender evaluates the loan, the mortgage, and if the property taxes go up and insurance goes up, a borrower's payment is going to go up and the lender will inform them. So it's up to the borrower to protest their property taxes and look for better insurance. Principal and interest stays the same on a fixed interest rate. That never changes until the loan is paid off. But the loan payment may change due to property taxes and hazard insurance. Now, the Real Estate Settlements Procedures Act, RESPA, know this, make a note of this, RESPA, limits funds the lender can require for this purpose. So the lenders have to be honest, and they have to provide a good faith estimate to the borrowers to make sure they can compare to others, and the lenders are being honest. So Real Estate Settlement Procedures Act limits funds the lender can require for this purpose. So they can't violate it and charge more to someone that they don't like, or, you know, we have the protection, okay, of certain categories, and they have to abide by that and not violate anyone, not discriminate. Okay, here we go. PITI, P-I-T-I, principal, interest, taxes, and insurance. Borrower's monthly payment for principal and interest is called the PI payment, principal and interest. The amount which includes the escrow payment is called PITI, principal, interest, taxes, and insurance. Now, charges and liens. Borrower is liable for paying any charges, liens, or other expenses that may have priority over the mortgage or trust instrument. Property taxes have priority over the first lien, the first mortgage, and paying any other charges and liens. Hazard and property insurance. So there is an order, a sequence in the order of priority of liens. Property taxes is first, then the mortgage, first mortgage, second mortgage, and then mechanics lien, judgments, so on and so forth. Hazard and property insurance. Borrower must keep property insured as the lender requires. There's no if and buts. That's a must. So those are one of the musts that could come up in the exam, that it says, must a borrower keep property insurance when they have a loan? Yes, that is a must. Normally, I would say be very careful when you see the word must. Always, never, absolutely. Okay, every now and then, those are triggers to wrong answer. Sometimes all the answers have the word must, so one of them has to be correct. Occupancy, preservation, maintenance, and protection of the property. Borrowers must take and maintain occupancy as the borrower's principal residence according to the requirements. So anyone who borrows an FHA, a veterans loan, or other state government loans, they must occupy the property for a certain number of years. That's required by the lender or Federal Housing Administration or VA before they could decide to rent it and convert it to an investment, which they can do that after the required time by the lender. So it has to be their principal residence, and the lenders will ask, is this going to be your principal residence? Because if it's not their principal residence, then they're going to pay a different interest rate and a higher down payment. They become then investors, or it's a second dwelling. So it's allowed to have a second dwelling as long as it's a certain distance from the property that's acceptable to the lender. Borrower must not abuse or neglect the including use for illegal purposes, creating hazardous waste on the property, or destroying the improvements. A lender could call it due. Okay. The due on sale clause is one of them, that if they were to transfer it or convey it to somebody else, the lender could call it due. But if they're violating it and destroying the property, the lender has to somehow find out if they are doing that. If not, when they have to sell it and the property is worth less than what the loan is, then they're going to be liable for the difference, the deficiency. Okay, protection of lenders' rights, property. Let me make it a little smaller. Protection of lenders' rights in the property. The lender may take actions to protect its right in the property, criminal stuff, okay, on it, drugs, and it devalues the property. The cost of these actions would be charged to the borrower, and they won't hesitate. Okay, lenders are there to make money, and they can foreclose. The mortgage insurance. So there's property mortgage insurance on loans that are conventional, and the FHA has, so that is PMI. The FHA is MIP. So keep those, distinguish those two. So lender may require private mortgage insurance, PMI, which protects the lender against loss from borrower default. It applies to loans that are not backed by the Federal Housing Administration. The Federal Housing Administration has the MIP, mortgage insurance premium, or Veterans Administration, and that have a down payment of less than 20% of the property value. So inspection, lender may inspect the property with reasonable cause to fear damage to the collateral. So if they sense or somebody reported the owners, the lender could request an inspection. Condemnation. Okay. Ginnie Mae is Ginnie Mae is also similar to Fannie Mae. They're government loans. I put that as a private loan on the tech. Yeah, that's not a private loan. Private loan is called a hard money loan. Hard money lenders, like the sharks, like the mafia sharks, right? The old days, and the Polish sharks, hard money loans. They charge high interest. So if condemnation, if a property is condemned or taken by eminent domain, lender reserves a claim. Oh, let me move my picture up. Lender reserves a claim of any resulting proceeds. So remember, eminent domain is the city taking property for public use. It's one of the police powers, and they can condemn a property that they need for whatever purpose within the city, growth. Okay, and the owner can protest it, okay, or appeal it. However, it's eventually going to be sold, bought by the government, and paid a current market value. But the owners can appeal it. Transfer of property by or a beneficial interest in borrower. So transfer of the property or a beneficial interest in borrower. If property without the lender's approval, the lender may demand immediate repayment of the loan balance. So that's the due on sale clause, or also known as this alienation clause. So the individual alienated the home. They left the home by conveying it to somebody else, selling it to somebody else, or abandoning it. Also known as due on sale clause, allows lenders to prevent unapproved loan assumptions. So regular loans cannot be assumable. Some FHA, some VA loans may be assumable, but that has to be declared when the loan is taken. And anyone wanting to assume a loan that an individual is selling their property still has to go through the mortgage approval from that lender. The requirement to repay the loan before the scheduled date is called acceleration. Just like we accelerate a car to get faster to go somewhere or avoid an accident, speeding, that is the due on sale clause. They accelerate the loan. They want their money now. Borrower's rights to reinstate. So if the lender holds borrower in default, the borrower has the right to reinstatement by performing certain actions, usually paying off overdue payments plus expenses the lender had. Interest, attorney fees, all those expenses, they add up real quick. The clause can reinstate their loan. They have a period of time to redeem the property. If there are foreclosed, for example, in Texas, I'm familiar with Texas, if their property is sold at the courthouse because of property taxes, that individual has 2 years to redeem that property. However, they will have to pay high interest on the loan balance, or the balance that the investor paid for it. So 25% interest the first year, 50% the second year. That's here in Texas. Let's see here. I like the way you said that. They want their money now. Yes, they do. So do hard money lenders. Now, there's some hard money lenders that have lots of properties that they'll cooperate with their individuals. So do lenders. A borrower could get a modification, a loan modification. There's a lot of documentation required. They have to be going through a hardship and show proof. And there's no guarantee that it'll be approved. That happened during the last crash in 2005 to 2012. A lot of people tried for loan modification. Some succeeded, others didn't. So okay, the redemption clause. So the borrower's right to reinstate gives the borrower and prevent a forced sale. Okay, because once it's foreclosed and sold, that's it. They can't redeem it at that point. Now, release of liens is what that stands for. Paid off the loan. Sometimes the lenders do not deliver those. The borrower has to follow through and request the release of liens from the lender and have a new deed recorded that no longer shows the vendor's lien. Now it's completely conveyed to the borrower 100%. Defeasance clause may require lender to execute a satisfaction of mortgage, also known as release of mortgage, release of lien. This more what we use, release of lien, but the lien is what? The mortgage. If deed of trust, lender directs trustee to execute a release deed or deed of reconveyance. Borrower is the trustor. The lender, the trustee is the person that the lender entrusted to follow all the proceedings of the deed of trust in case a borrower default. The beneficiary is the lender. So release deed, yes, it must be recorded. If it's not, it'll continue showing a vendor's lien on there, and that'll show whenever someone wants to buy another property or get another loan. They say, well, you still have a loan. You still have a lien on your property. You can't refinance it for the amount that you want. So that has to be taken care of. And that'll get a lot of people in the trouble when they're home and it's at the title company or with the attorney and they're doing the title search. All that will show up in the title search. That becomes a cloud on title, a cloud on the deed that needs to be cleared. So we need to clear the sky, open the sky and make it clear, right? Clear, get rid of the clouds. Escalation clause allows lender to increase the loan's interest rate. Sometimes with a lower loan at the beginning so they can afford to make the payments, because the borrowers say, well, I just got a job transfer. I'm going to have higher income in a few months or a year. So then the lender says, okay, we'll provide you a lower interest rate for 12 months or 24 months. And then after that, the loan will escalate until it gets to the interest rate that we require. So loan qualification. So there's a loan qualification and the loan pre-approval. The pre-approval requires all documentation by the borrower to be delivered. Loan qualification doesn't. So Equal Credit Opportunity Act. Let me I was hoping to get more. Then let me do this. So Equal Credit Opportunity Act. So the income and credit scores. and all their income and debts and such. Lender cannot deny credit based on discounted income from part-time work, future plans to have family, locational factors, protected classes. So lender cannot deny credit based on discounted income from part-time work, future plans to have a family. People are allowed to have that. Locational factors, they're relocating. Sometimes they'll provide 2 years of having relocated or having a job. There's scenarios and exceptions. Protected classes, right? The 7 protected classes that they cannot deny that. That's why it's good to get a good faith estimate, the borrowers, when they go to different lenders so that they can compare. Income qualification, and the lenders have to disclose all the closing costs and not deny anyone, except because they can't be pre-approved, okay, because of credit issues. So income qualification, income ratio and debt ratio qualify borrower's income. Income ratio applied to gross income determines housing expenses maximum. Debt ratio takes revolving debt into account. Revolving debt like credit cards, okay, or home equity line of credit. That's a revolving account. So income ratios 25 to 28% on conventional, up to 31% FHA insured. Sometimes they'll allow more. Debt ratios 36% for conventional and 43% Federal Housing Administration and VA. So the income ratios, they want this. For debt, they can have 36 for conventional and up to 43% on FHA and VA. So that's a high debt. So cash qualifications. Lenders verify applicants' sources of cash for down payment. They check to see where did you get the down payment from? Was it a gift? Was it family? Was it borrowed? Well, you have to pay on it because they want to be the primary lender. They want to be in first place. And if they borrow the money from somebody else, they're going to have an extra payment, right? That increases their debt to income ratio. So lender verifies applicant sources of cash for down payment. Extra cash enhances income qualifications evaluation. Lenders will sometimes accept a family gift, but they have to know. They'll see all the statements, monthly statements, and the income tax returns, 2 years of income tax returns, several months of bank statements. Up to the last minute, they'll ask for bank statements again, hoping that the borrower didn't go and make a lot of purchases and take money out. So there has to be a certain amount of money in the bank for them to get pre-approved and be able to pay for the down payment and other expenses. So a borrower's net worth, extent to which applicant's assets exceeds liabilities as a further source of reserve. So they have retirement plans, 401k, in stocks, IRAs, and Roth. However, with the IRAs and the Roth, if they take money out, there's a penalty, right? And 401k, they can take money out, but it doesn't happen immediately. It takes a little bit of time. So applicants' payment behavior. And sometimes, even though they have a lot of debt or credit cards, but they still have a high credit score because they make their payments in time. So the lender is going to look at these income ratios here. Are they making sufficient amount of money for all the debt that they have? And some people may, okay, even though they have a lot of credit lenders or credit cards. So lender obtains their credit report. Sometimes they'll obtain the credit report during the application and then again at the last minute before closing. And unfortunately, some individuals even though advised not to make any any purchases prior to closing, will go and charge furniture. They get excited and they go buy a car, and then that changes their debt to income ratio, and they're not qualified. They're not approved. Their approval is then denied. Loan commitment. It's a written pledge by the lender to grant loan under specific terms. Firm, lock in, conditional, take out. So once they have been approved, the lender wants to firm in the rate, lock in the rate. And then it may have some conditional restrictions or conditions they still have to meet, and then the takeout. Loan to value ratio, LTV, relationship of loan amount to property value. So is the loan an 80% loan to the amount that they're going to purchase? So that would be an 80-20 ratio. The loan is 80%, the down payment is 20 in order to make 100% to make the purchase. Expressed as a percentage. 80% loan to value, the loan is 80% of the property value. Not the sales listing, but the contract loan amount. Some realtors confuse that it's 80% of the list price. No, it's 80% of the contracted price that's going towards closing. So private mortgage insurance, PMI, on conventional loans must insure portions of purchase price to adjust loan to values that are too risky for conventional lenders, decreasing a 90% loan to value to 80% value with PMI insurance. So once an owner, let's say they had a 90% loan to value, then they have to have PMI. Once they get to 80% equity or 81%, then the PMI can be removed. The borrower has to request for that to be removed. So the lender now feels safe that should that borrower default, the lender will be able to recover the money they loaned, right? Because there was 20% equity to play with, and the market may have improved and the property increased in value, appreciated. So PMI may be removable via increasing property value and decreasing. Laws affecting mortgage lending. Truth in lending and Regulation Z. So Regulation Z implements Truth in Lending Simplification and Reform Act and Consumer Credit Protection Act. Lender must disclose finance charges and the APR. Remember, the APR includes the finance charges and other fees that the lender charges, and that increases the interest rate on the mortgage to the APR. The APR is always larger than the mortgage insurance rate. So prior to closing, they must disclose everything. Borrower has limited right of rescission, but excludes primary residence. Lender must follow advertising requirements for full disclosure of cost, loan mechanics. So that's the truth in lending. So borrower has limited right of rescission, but excludes the primary residence. Okay, so advertising and disclosing everything. Truth in lending, Regulation Z, advertising. So it's the Truth in Lending Simplification and Reform Act to protect the consumer from fraudulent lenders, and the Consumer Credit Protection Act. So Equal Credit Opportunity Act, ECOA, know your acronyms, prohibits discrimination in lending basis on the 7 protected classes: race or color, religion, national origin, sex, marital status, age, and dependency upon public assistance. Okay, disability. Okay, and so that's where some people get as fresh corn. Okay, but here you don't have you don't have the F, you have the two R's. And so I'm trying to remember, familial status, okay, is the marital status. So fresh corn works when they use the right familial status or disability. Well, on fresh corn, there's no disability on there. But that's a way that some of my students told me years ago is prep agent Joe Juder. He's got a YouTube channel with over 330 subscribers. He's been in the industry doing that for years. So he does much more of what I do. Has been doing predominantly national, but then he started adding some states, and he's excellent. He's very straight, direct, and he also is a collaborator with Aceable Agent, the school that also teaches real estate classes for getting your license. Okay, so ECOA prohibits discrimination based on the 7 classes, and licensees assisting and qualifying must also come. And denied applicants must get notice within 30 days. And it has to be due to credit issues, or something like that. It can't be because of any of these status. No discrimination. The Real Estate Settlements Procedures Act, RESPA, standardizes settlement procedures and ensures buyers understand settlement costs. Settlement costs that would be on the cash deal still use the HUD-1. And the HUD-1 now is only used for cash. Anything that has a loan is called a closing disclosure. But it's a settlement statement that has all the debits and credits for the borrower and for the seller. And they both have to end up equaling on both sides. That's accounting, right? Debits and credits end up having to equal at the bottom. Lender must provide CFPB booklet explaining loans, settlement costs, and procedures. Okay, I forgot credit for, hold on, let me, forget what some of these acronyms are. Oops. CFPB booklet in real estate lending. Consumer Financial Protection Bureau. You see how easy it is to forget that because we don't use it. So the loan estimate closing disclosure, Consumer Financial Protection Bureau. CFPB features provide CFPB loan estimate of settlement costs within 3 days of application. Unfortunately, that doesn't always happen where the lender provides it. If the borrower asks for it, they'll get it. However, many borrowers don't know about it, right? So we as realtors should advise them to get a settlement statement in advance, an estimate, a good faith estimate, because the Consumer Financial Protection Board recommends that the lender provide that within 3 days of an application, not when they're just comparing. Once they have submitted all their, they have filled out an application. A lot of times it's done online nowadays, and provide all their documents, then the lender came with that settlement statement or good faith estimate of what all the settlement costs are going to be. And they can ask then, are there points? Are there origination fees? What other costs are you charging me? Because it gets expensive. So it is within how many days? Within 3 days after the loan application. Okay, not when they first call them and talk over the phone and they get a pre-qual. A lender can pre-qualify them over the loan by saying, well, how much do you make? How much debt do you have? And do you own a car? Do you own this? Do you own that? It's okay, well, you might be able to qualify for this amount of loan. Well, that is not a pre-approval. So what we want to ask for when we are realtors and representing a lender, a seller, is get a pre-approval from the borrowing realtor, from the buyer's realtor. They'll say, well, I have a pre-qual. Well, that's not good enough. Okay. Provide CFPB closing disclosure 3 days before loan consummation. So 3 days before the closing date, the lender and title company will provide the closing disclosure, the settlement statement, giving the borrower 3 days to review it, and they could still back out. National Flood Insurance Act. However, if they back out, they may lose at that point their earnest money. National Flood Insurance Act. So borrowers of federally related loans must obtain flood insurance if property is in a designated flood hazard area. So for federally related USDA, different loans like that. Flood zone maps, and even if it's a conventional loan, it might be a good idea for the borrower to have that in an area that there's a lot of flooding. So flood zone maps indicate where homeowners must obtain insurance. So most lenders, most insurance companies, is where a borrower can find out if there's a flood zone area. We as realtors, we're not experts in flood area. We can evaluate the map and learn if it's a flood zone or not. But we could be liable for telling the borrower. It's better for them to talk to an insurance company, or we send them to certain websites where they can find out. Because if they don't get flood insurance because we say, oh, well, no, it's not in a flood insurance, a flood area, then we're liable because that's what we told them. And they might be have been required to have flood insurance. Oops. Then we have an expense on our hands. So I've learned through the years that sometimes we can't share certain information that we're not experts in. It's best for the borrower to do their due diligence. They need to learn on their own. Okay, the mortgage market, supply and demand money. Relationship between supply and demand for money affects interest rates, consumer prices, availability of mortgage money, regulated by Federal Reserve, right? The economy, supply and demand, economics. Federal Reserve control of money supply among banks. Sell T-bills to reduce money supply and increase interest. interest rate. So sell T-bills to reduce money supply out there and increase interest rates. Buys T-bills to increase supply and decrease rates. So the Federal Reserve can buy those T-bills to increase money out in the market and help decrease rates. It sets the reserve requirement for member banks, increase reserves to tighten money and raise interest rates. Makes it harder for borrowers to get loans, right? Decreases reserve to loosen money and lower interest rates. It also sets the discount rate for member banks, increase rate of tightened money, decrease rate to increase money supply. So you see the supply and demand. If supply is down, is tightened, interest rates go up. If supply of money is increased, interest rates go down. And that sets the discount rate for their member banks. Federal Home Loan Bank System, FHLBS, counterpart to the Fed for Savings and Loans Association. Many, many years ago, the savings and loans companies got in trouble, got a lot of people in trouble, and they went out of business. Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per depositor at a bank, per insured bank, for each account ownership category. So if you were to have $500,000 in the bank is going to insure deposits up to $250,000. What happens to the other $250,000? So that's per insured bank, per insured bank. So they may want to take the other $250,000 to another bank, or put it in a different type of bank, like a money market account, for each account ownership category. The primary mortgage market. So what is the primary mortgage market? The primary mortgage market originates mortgage loans directly to borrowers. So that's the banks, mortgage brokers, mortgage lenders, mortgage banks. Includes savings and loans, commercial banks, mutual savings banks, life insurance companies, mortgage banks, credit unions. A lot of people join credit unions because for the most part, they usually have better rates. And it usually requires being referred or being a member of a family. But there are more widespread, and we don't have to be a family member. So they're a lot of times good, and they offer more services than some banks. The secondary, and other times they're not as user-friendly, okay, because they're providing lower rates to union bank members, credit union bank members. And so some people may not like them. I like them. So the secondary market, mortgage market, buys existing loans to provide liquidity to primary lenders. Fannie Mae, Ginnie Mae, Freddie Mac, investment firms, life insurance companies, pension funds. So they buy loans in the secondary market, thus providing more money to primary mortgage companies, okay, to lend to borrowers. So role of Fannie Mae, Ginnie Mae, Freddie Mac, and FMAC. No, Freddie Mac, FMAC, FH, no, I forgot that one. Okay, hold on here. Let me get my Google. So what was it here? FHLMC. Come on. It's working a little slow, but it's coming. So it is Freddie Mac. So Federal Home Loan Mortgage Corporation, commonly known as FAMC. So I forget the acronym, but you'll want to remember them. So Google is thinking. Farmer Mac, Federal Agriculture Mortgage Corporation. Okay, so there are lenders for farmers, agriculture. Farmer Mac, Agriculture Mortgage Corporation, FAMC, Farmer Agriculture Mortgage Corporation. So Fannie Mae buys conventional FHA and VA backed loans and pooled mortgages, guarantees payment on mortgage-backed securities. So when Fannie Mae, Ginnie Mae, Freddie Mac, and Farmer Agriculture mortgage companies buy these conventional and FHA, then it provides more money to the primary banks, to the primary mortgage companies. And Fannie Mae insures the loan for a lender, to the lender. VA guarantees the loan. Know that. Fannie Mae insures, that's why they pay MIP. VA guarantees the VA loan to veterans. Ginnie Mae guarantees payment on certain types of loans. Freddie Mac buys and pools mortgages, sells mortgage-backed securities. So investors end up buying those at a lower price, right? They bundle them and sell them. So buys and pools mortgages, then sells mortgage-backed securities. Then the Farmer Mac, Agriculture, operates in the agriculture financing markets by stimulating and expanding agriculture credit availability for agribusiness. You know, a lot of times farmers go through very difficult times, and they're there to help. Not always if they've exceeded their ability to get loans. Okay. So, yes. So mortgage loan originator versus lender/banker versus broker. Okay, so three different things. So a broker is like our real estate broker, right? We have a lot of realtors, but brokers have different banks that they work with. Lender, banker, that's the bank that you walk into. So mortgage loan originators, they solicits, negotiates mortgage loans, requires MLO license, mortgage loan originator license. A lot of realtors end up getting their MLO license, and I may be representing buyers, then I'm going to get my MLO license. Mortgage broker, an intermediary who brings mortgage borrowers and mortgage lenders together. Okay, so that's a mortgage broker here versus a lender or a bank, but does not use its own funds to originate mortgages. So they have a pool of banks that they work with and bring borrowers to feed their needs by checking out different mortgage companies, different mortgage banks. Now, a mortgage banker is a person or entity who funds or services loans and or who sells mortgages to the secondary market. Let me okay, here. So the types of loans: mortgage loan originator, solicits, negotiates mortgage loans, requires an MLO. So they collect all the information. The mortgage loan originate. They originate the loan. The mortgage broker is an intermediary between mortgage lenders, and the borrowers. The mortgage banker, person or entity who funds or services loans for others and or who sells mortgages to the secondary market. So the mortgage banker, they loan the money at their bank. Like if you go to Bank of America, Wells Fargo, or Chase, it's their money that they're loaning, not other brokers, not other banks. It's their own. So they hold the loan. They may sell it like it sells here, who sells mortgages to the secondary market. So types of mortgages: conventional mortgage, FHA or a VA, originated by banks and private financial institutions. No government-related insurance or guarantees as with FHA and VA. Remember, FHA is insured, VA is guaranteed. Typically require 20% down payment. Smaller down payments may require PMI. So sometimes there is a 3% down payment minimum or 5%, but then they're going to have property mortgage, private mortgage insurance. Assumptions require approval. They could have assumable loans, but they do require approval. Then there are government loan programs, FHA and VA, federally insured loans, and then VA, federally guaranteed loans. Amortized fixed rate versus adjustable loans. So let's see, Max says, that was on the test. I didn't know the farmers had their own. Yes. And there are also lenders that focus just on land, agriculture land. Not everybody wants, most lenders do not deal with land because it's very risky, right? Land is pretty much fixed. It doesn't have improvements on it. And so they'll require a larger down payment, minimum 20%. Amortized fixed rate versus adjustable loan. Amortized payments include increasing increments of principal, which retire loan balance over loan term. Makes it a little confusing the way they word it, okay? But the payments include increasing increments of principal, meaning every month the principal amount, the money that goes to the principal of each payment increases, and the interest rate starts to decrease, but that takes several loans, which will retire the loan balance over a loan term. So typical loans are 30-year amortized, so to make the property payment. So the fixed rate, an interest rate that does not change throughout the term of the loan. It can have amortized or interest-only loans. And interest-only loans, the borrower is only paying the interest of the loan, which would be a very low interest, and they take them for a short time. The principal never decreases. They're only paying interest, but they're fixed rate. Now, there's also adjustable loans. Interest rate fluctuates up or down with the index. Payments may also vary. Sorry, I forgot to put my phone on mute. It's a family call, but I can't take it. I can't seem to put it on mute while the phone is going. Okay, so adjustable rate mortgages, they're also called ARMs. Rate mortgages, and however, the ARMs, they can be they're usually an odd number, 3, 5, 7, 9, or 10 years. Adjustable loan characteristics, mechanics. The mechanics of a loan, adjustable loan characteristic is the rate adjusts up or down with index. Payments may or may not change. Negative amortization. A loan balance increases if payments are less than what is owed given the balance and the rate. Unpaid monthly amounts are added to the principal balance. So sometimes a lender that'll provide a lower interest rate at the beginning so that they can afford the payments, the difference will be added to the back of the loan. So that's a negative amortization. Any interest that is not paid or principal. So typically it's the interest that's getting paid, right? So the principal is added to the back of the loan. So the loan, the principal amount keeps increasing. Rate and payment caps, maximum amounts the interest rate or payments can increase in a given adjustment period. In other words, ARMs, adjustable rate, and how much they can increase that interest rate in a certain time. Why does that seem confusing? Because we don't normally think of negative amortization because they're paying less amount. So loan balance increases if payments are less than what is owed, given the balance and the rate. Unpaid monthly payments are added to the principal amount, and that increases. So now they're going to be paying interest on interest not paid. So people get into trouble when they're not making full. Sometimes banks will not accept a partial payment, but this is a negative amortization that is provided by the lender. And the adjusted rate has a cap. So it protects the borrower from unaffordable increases. Index and margin. Interest rate tied to any number of financial indices. Margin equals a fixed point spread between the index and the interest rate. Sorry, I need to wet my throat. So margin equals a fixed point spread between, so there's a spread between the index and the margin, between the index and the interest rate. Teaser. So if the index changes, so does the interest rate. Teaser rates to attract, and if you want to, teaser rates to attract borrowers, adjustable loans may have low interest rates, which they typically do, which increase over subsequent adjustment periods to a more permanent market level. So it could, like mention, a 1, 3, 5, 7, usually adjustable rate mortgages are lower. And so these are teasers saying, hey, yeah, we can give you, and some builders will do that. They have teaser rates, say, hey, you'll have a low interest rate for the first 6 months, but then after that, it'll go back to the normal rate, which is what they call the permanent market level. And that's how builders attract some borrowers, some buyers. So custom mortgages, partially amortized with a balloon. So payments will not require principal balance over the life of the loan, thus requiring a lump sum payment or a term. So the loan, let's say the loan is for 5 years, or for 10 years. So they'll amortize it for either the 30 years, but at the end of the 10-year period that the loan is, the term, then they have a large payment to pay, a balloon payment. Now, there can also be amortized loans. Somebody says, well, I want a 10-year loan. So they're going to pay it off in those 10 years. So it's amortized for 10 years, not amortized for 30 years. So their payment is going to be much higher than if they were stretching it out for 30 years. Very rare for anybody to do that as a private residence. They might do 20 years and amortize the loan for 20 years, pay it off in 20, but it's typically 30. Interest-only loans. Loans where payments are interest only. Principal is not impacted. Principal stays the same. And the principal balance is retired in full at maturity using a balloon payment. So the full amount of the loan that they got to begin with is what is due at the end of the term at maturity. Principal balance did not change. All they paid was interest because the interest was low for them to be able to either construct a property or deal with an investment property that they're improving. So they just needed it short term, a lot of times 1 year, 2 years. Okay. Biweekly mortgage. Loan payments are every 2 weeks, a de-risk period for the lender. So in order to do this, a borrower cannot voluntarily just start paying every 2 weeks. It has to be approved by the lender that the borrower can pay every 2 weeks, thus reducing the amount of interest that the lender gets. Instead of waiting 30 days and getting interest for 30 days, the borrower is getting interest for 2 weeks. They pay some and then 2 more weeks. So there's less interest being paid when they pay 2 months in 1 month, 2 payments in 1 month. A package mortgage. Mortgage loans which also finance articles of personal property as part of the purchase transaction. Most lenders don't want to deal with personal property for a home mortgage. But in this case, a package mortgage, a loan that finances articles of personal property as part of the purchase transaction with the home. Home equity loans, funds borrowed using the home equities, the homeowner's equity for collateral, fund for any purpose. So there's home equity loans and then home equity line of credit and a revolving account. And I'm not sure if they're going to mention that. So a home equity loan is getting a loan on the equity of the property. It's a regular loan. A home equity line of credit is getting a loan on the property's equity. However, they only use it when they need it, like a credit card. And so they do charge a fee for that. And it's only for so many years and typically have a lower interest. Right now, here in Texas, the interest rates for a home equity line of credit are over 6%. There was a time when they were also 3% and 2%. Purchase money mortgage. A seller financed loan to the buyer using the property as collateral. Purchase money mortgage. A seller financed loan. Owner financing first mortgage. And so the lender would have to, approve something like that, because then there's 2 types. There's 2 loans involved and the lenders want to be the primary. But if this is a secondary, it's okay. Sometimes the lenders will allow a subordinate loan because they are the primary lender. The concern is, can the borrower make both payments? So the lender could say, okay, we finance 80, and the owner says, okay, I'll finance 20% of the balance. So that now 100% is financed. So reverse annuity mortgage. So then there would be 2 liens on that property. Reverse annuity mortgage, a financial arrangement, periodic payments of the pledged equity. So the owners maybe have a home that is fully paid, they're older, and they want to get monthly payments coming in from their equity. So they'll do a reverse annuity mortgage, a reverse mortgage. In essence, it is the periodic receipt of equity liquidation. So they're liquidating, they're using up their equity that they've gained on the property, on their home, in exchange for an increase of debt owed on the property. So now they're going to end up having a debt owed on the property. And if they already had a debt, but they had huge equity, then they could still have, that's why it says increase of debt owed on the property. A lot of some retired individuals will do that. FHA loans, insured loans granted by approved lenders to qualified borrowers. Loan term, 15 years, 30 years. Qualifying ratios: income 31% and debt 43%. Debt to income ratio. So they can have up to 43% debt, but they have to have at least 31% of income to meet the requirements. Minimum down payment 3.5%. So that's an FHA. Mortgage insurance required at 78% loan to value or above. Premium equals one time 1.75 to 2.25 of the loan amount plus the annual premium. Okay, so they're paying their annual premium of homeowners insurance, and then they're paying 1.75 to 2.25 of MIP, mortgage insurance premium, on an F. And then maximum loan varies by metropolitan statistical area. So FHA loans aren't like for low income people. FHA loan, I think, has been increasing maximums. I forget what the current max FHA loan maximum is right now. Let's see, maximum. They used to be 300 and something, then they went up to 500,000. And let's see what they are right now. I deal more with sellers than I do with borrowers. So a loan maximum amount for a single home range a floor of 500 to a ceiling of 1,249,125 in high cost areas. So they also have it for duplexes and for fourplexes, right? Because they condominium association don't want to accept them because they think they're going to attract. It's just a loan that requires less down payment and it has to be insured. So maximum loan amount varies by metropolitan statistical areas. VA loans, they are guaranteed loans by the government, granted by approved lenders to qualified veterans. So veterans have to be approved by the Veterans Board, get a certificate of approval that they then present to a lender. A lender will not work directly with a veteran if they don't have that certificate letter of approval. So qualifying ratios depends on the lender. Minimum down, none, 0. So those closing costs are paid by the seller. So sellers are educated that if you're going to offer the option to receive VA loans, be prepared to pay a lot of closing costs. Points, 1.25 to 3.3, right? Remember, that's one point is 1%, okay, of the loan amount. 100 per thousand, 1 point is 1,000. Depending on the down payment, type of loan, type of veteran. And a veteran down payment, they're not required, but they can put a down payment if they so wish. All right, so we're done with finance. That took us almost an hour and a half. Okay, so we're only going to do a few questions. And let's go here. Let's shift into questions. I think we're on not that. Let me see here. I thought I had a finance. Oh yeah, it is 3 so far. And that's where you can get some finance questions, math questions. Okay, what is a lien theory state? So these are national questions dealing with finance. Go back. Max had a question here. So amortization definition in the book, the gradual reduction of loan balance through regular payment. What it seems confusing on the test. That's what it is. The amortization schedule, every month, the principal amount that is owed will be decreasing. Okay. However, very little bit of the monthly payment goes to the principal the first few years because of the interest rate. A larger portion of the monthly payment goes towards interest. So very little of the principal balance is reduced every month. So the equity is growing a little bit, a little bit, a little bit until the years go by. If they have a low interest rate, like during COVID, there was as low as 2.5 to 3.5. A lot more is going through principal than to interest, maybe almost like a 50-50, or, I'm not sure the percentage, but a lot more is going towards the principal, therefore gaining more equity in a shorter period of time. But that's what amortization is. It's a gradual reduction of the loan balance. So it's a schedule that shows every month, okay, this much from the monthly payment of 1,000, 100 went to principal, 900 went to interest. And then, of course, then the taxes and insurance, if there are taxes and insurance. So if the payment had taxes and insurance, then a small amount goes to principal, large amount goes to interest, and then the escrow portion goes to property taxes and to insurance. Okay, what is a lien theory state? There are lien theory states and title states. A state in which a mortgage holds legal title to a secured property. Okay, so the lender keeps the legal title to a secured property. B, well, let me reduce that. And let's put it all on one page. Okay, I'm gonna get out of this screen and make a change here, because I thought this would work, but it's not. Let's go to single here. All right. And then go. Okay, there we go. It was splitting the screen. So it holds legal title to a secure property, a state in which a mortgage, C, a state that allows a real estate owner's creditor to record liens against the owner's property, or a state in which a lien is considered a conveyance. So under finance, they didn't really discuss lien theory or title theory states. Okay, so a lien theory state is a state in which the mortgagee holds title to a secured property. So the mortgagee being the lender. So the answer to 7.1 is A. You're in a lien theory state. Okay. It says Max. 7.1. Oops. Oh my gosh, what the heck did I do here? Oh no. I clicked a button and it screwed up my screen. So 7.1a is a lien theory state. The mortgagee, the lender, holds legal title. Ooh, that didn't work, huh? Number 2, what is the function of a note in a mortgage or trust deed financing arrangement in the collateral property? B, it is evidence of ownership of the mortgage or trust deed. C, it contains a borrower's promise to maintain the value of the property given as collateral for a loan. Or D, it is evidence of the borrower's debt to the lender. The promissory note, what is that? In a mortgage or a trust deed? So the answer to number 2 is D. It is evidence of a borrower's debt to the lender. Okay, I promise to pay you this amount, so much a month for so many months, or however they schedule that. Oh, I forgot to show the answer for 1 and the answer for 2. Number 3, when home buyer, oh, I forgot to read some of these title. Okay, I'm going to go back. I'm going to read a little bit more on the lien theory state on 7.1. So 7.1 says states differ in their interpretation of who owns mortgaged property. So we are on this one. Those that regard the mortgage as a lien held by the mortgagee, the lender, against the property owned by the mortgage or the borrower, the OR and the EE, are called lien theory states. Those that regard the mortgage document as a conveyance of ownership from the mortgage or to the mortgagee, mortgage or being the borrower to the mortgagee being the lender, are called title theory states. And then for number 2 here, 7.2, it is evidence of the borrower's debt to the lender. A valid mortgage or trust deed financing arrangement requires a note as evidence of the debt. Okay, D is evidence of the borrower's debt to the lender. Number 3, when a home buyer, Henry, pledges his newly purchased home as collateral for a mortgage loan, the evidence of the pledge is the 1A, trust deed or mortgage, B, promissory note, C, loan commitment, or D, loan receipt. So it's not a receipt, okay? The answer for 7.3 is a trust deed or a mortgage. So in your state, Max, you have a mortgage. In my state, Texas, we have a trust deed. So we're a title theory state. The deed is conveyed to the borrower. In your case, the deed stays with the lender, the mortgagee. Number 4, the borrower in a mortgage loan transaction is known as, the borrower in the mortgage is known as A, mortgagee, B, mortgagor, C, lienor, or D, trustee. The answer for 7.4, here we go, the OR and the EE, the giver and the receiver. So 7.4 is B, the mortgagor. That is the borrower. The mortgagee is the lender. see what it says here. The mortgager is the borrower, the mortgagee is the lender. As a memory aid, notice that lender and mortgagee both have two E's. Oh, that's a good one. The borrower and okay, but it doesn't say lender. But lender has two E's, and then mortgagee has two E's. So mortgagee, lender, EE, both have two E's. Mortgage or and borrower both have two O's. That's another way compared to the OR and the EE rules. But that's what it is, right? Well, we think of it as the giver and the receiver. So the borrower here is the giver to the mortgage company, right? To the mortgagee. So there are the mortgagor. That's the first time I see that. All right, number 5. If a borrower obtains an interest-only loan of $200,000 at an interest rate of 6%, what kind of loan? Interest only. What is the monthly interest payment? A, $1,200, B, $600, C, $500, D, $1,000. So we've got what? 6% annual interest rate. Alarm. I have all kinds of alarms. An annual interest rate of 6%, right? So we've got to multiply the 6% times what? The 200,000. And then what? Divide by 12, because we want to know. So here we're dealing with annual interest rate, and here they want the monthly interest payment. So we have to do a conversion, right? So 200,000 times 6% is what? 12,000. Yep. Then divide that by 12 will give us D, 1,000. So the interest payment on that $200,000 loan for 1 month is 1,000, because for 12 months it's 12,000. Divide that by 12 is 1,000. You can sometimes do these on your head, but best to do it on a calculator or pencil and paper. Math is meant to be done in writing. When I went to school, I didn't have calculators. So it was pencil and paper, and work backwards to check our answer. Number 6. Did I show the answer? If a borrower's monthly interest payment on an interest-only loan, again, on an interest-only loan at an annual interest rate of 6% is 5,000. So now they're giving us the monthly payment and the interest rate. They don't give us what the loan amount is, the borrower's monthly interest payment. So it says, how much was the loan amount? So now we got to work backwards, right? So on this one, we've got 5,000 times 12, because we're dealing with annual, and the borrower's monthly interest payment is 5,000. So first we got to multiply 5,000 times 12, right? So that gives us what? 60,000. 5,000 times 12. And then we must divide by 0.6. On this one, it was times 0.6, right? 0.6 times 200,000, because we had the dollar amount, the value of the property. Here, we do the opposite. Same formula, just written differently, solving for a different factor. So 5,000 times 12 is 60,000, multiplied by 6. No, 5,000 times 12 is 60,000. Divided by 0.06 is going to give us a very large number, because we have a large number on top and a very small number on the bottom, which is a percentage. Therefore, we have to end up with a very large number. So we end up with what? 1 million. So 60,000 divided by 0.06. So 6 goes into 6, 1. And then you add all the zeros and you get 1 million. So did you follow that? 5,000 times 6% gives us, and why are we doing it that way? Because 6% is for the whole year. 5,000 is 1 month interest payment. So we have then $60,000 of interest payment in a year. So now, I'm sorry, we multiplied 5 times 12. I'm sorry, not 5 times 6%. Excuse me, go back. 5 times 12 months, okay, was 60,000. So now we're going to divide that by 6% to get the answer, the value of the property, okay, the borrower's loan amount. And so what I said was, okay, so you've got 6%, 0.06 divided into 60,000. So we know it's not going to be 5, and it's not going to be D, and it's not going to be A, because the answer has to have a 1 in it. So your guess could be, if you don't calculate it, could be B or C. Okay, but 60,000 divided by 6 gives us a 1 and all the zeros. So if 1 million, 7.6 is B, as in boy. So when you're doing these, you want to look at the whole picture, not start trying to figure it out, and see it that way. Okay, see how you can reduce the equation, or reduce the fraction. In this case, it was 60,000 over 0.06. So reduce that so that you can come up with the 1 million. We can't see the entire problem. I can see it. Oh, well, yeah, you can see there's the whole problem. I see the whole problem on YouTube. If you mean the solution, no, I'm not showing you the solution. I'm verbalizing it. Okay, I don't have the solution on the screen. I'm verbalizing it. It would be in the answer of the book, and I would have to open a different screen with Kindle in order to be able to show it to you. All right, number 7. I mean, I could try to do that, but we're almost at the end of the class. And Kindle takes a little time to open up. Let's see if it'll come up. Okay, number 7. A borrower of a $250,000, again, interest-only loan, makes annual interest payments of $850. Okay, so now here we're dealing annual with annual. So the interest only is for annual period. And so an interest rate is for the whole year. So the loan, okay, so 250,000 interest only loan makes annual interest payments of 18,750. What interest rate is borrower paying? So what interest rate is borrower paying? So here you have two numbers. We don't have to deal with an interest rate. So we have the part. So this is like in the T formula, where you have the part divided by the whole. So here it's 18,000. So we're solving for the interest rate. So in the T formula, you have three factors. On the top, you have the part. On the bottom, you have the whole. The whole in this case is 250,000. times then the interest rate or another factor, right? So here we have 250,000 that is divided into 18,000. So 18,750 is the part. So 18,750 divided by the 250,000 is going to give us a small number, and that's what we need. So when you have a small number on top, a large one on the bottom, we're going to get a small number. All right. So in the other one, I said when you have a large number on the top and a small number on the bottom, you're going to get a big number. Here it's the opposite. Oops. Small number on the top divided by a large number is going to give us a small number, an interest rate. So by looking at the numbers on there, okay, you wouldn't be what, 0.75 on number 7, because that's a really small interest rate for having 18,750 interest in the year. Okay, so it's going to be A, C, R, D. So when you divide 18,750 divided by 250, the answer is 7.5. You could kind of manipulate this a little bit and say 25 into 18 and round it off. You'd have to be using your paper or your calculator. So no, it's not 0.75, or is it? No. The answer here is A, Max. It's 7.5. Oh my gosh, if there's a 0.75 interest rate, woo, man, there's going to be a lot of demand on real estate, right? Because people are getting to buy a lot with their money. So no, 0.75, no, it's 7.5. Yes, you had the decimal in the wrong place. So you could quickly eliminate 0.75, and then, you know, you'd have to guess on the others if you weren't sure. But 3.75 also would be rather small. So it's either A or D. So the answer here for 7.7 is A. The equation for the interest rate is annual payment divided by loan amount equals the interest rate. So the annual payment, the annual payment divided by the loan gives us the interest rate. Number 8. And the other one was the equation for the loan amount is the annual interest rate divided by the annual interest divided by the interest rate in order to get what the loan amount was. So it's the same formula, just written, solving for a different factor. So Maria borrows 600,000 and pays 2 points for the loan. So what is 1 point equal to? It's 1%, not the purchase price of the loan amount. How much does she pay in points? So 600,000 times 2 points. Right? So you're moving the decimal back 2 places. So is it 1,200? So 2 times 6 we know is 12. So the answer is not C and it's not D. So now is it 12,000 or is it 1,200? 2 points is move the decimal 2 places. 1, 2, and then times 2. So 6,000 times 2 gives us 12,000. Yes, the answer is B. 7.8 is B, 12,000. So that's how you can calculate it quickly. So 2% is 0.02, right? So they move the decimal 2 places back from 2 to then 2.0 to 0.2 to 0.02. Move the decimal from here on the right. Add a note. Oh, I guess I could do a note there. So you have, oh, but then it's real small. 6,000 times 0.02 equals 12,000. Yeah, that's really small. You can't see it. And I don't have a writing tool on here. All right, so 7.8 is B. I'll figure out how I can add a writing tool for these for another time. With those decimals, quickly miss the answer that way. Oh, come on. My goodness. It's going to end up being small. Okay, 7.9. Which of the following is true of an amortized loan? Amortizing loan. Which of the following is true of an amortizing loan? An amortizing that stretches the payment for the length of the loan period, the term. A, the amount of annual interest paid is the same for every year of the loan term. B, part of the period of each periodic payment is applied to repayment of the loan balance in advance. C, except for any points that may be paid, the interest on the loan balance is usually paid in advance. D, the interest rate is reduced each year to maintain the monthly payments, maintain equal payments, even though the outstanding loan balance is smaller. So which one is true of an amortization? Like a portion goes to the interest, a portion goes to the principal. So the answer here, 7.9, is B. Part of the periodic payment is applied to repayment of the loan balance, that's the principal, in advance. And part is applied to the payment of interest in arrears. The interest is always in arrears. It adds up as the days go along to 30 days. The loan balance, it's a repayment of the loan balance in advance, right? Every month it's going less, reducing a little bit. It's applied to repayment, repaying the loan in advance, and part is applied to payment of interest in arrears. Interest is charged in arrears, kind of like we use our water and then we get the bill. We use electricity and then we get the bill. So we're paying in arrears. So that question was in the test. Okay, good. You remember a lot of your questions, actually, Max. That's really good because you can notate that when you get out of the exam. Oh, there. Number 10. For a loan that is not backed by Fed and for which the borrower is making a down payment of less than 20%, the lender is likely to require the borrower to obtain what? A subrogate. We have internet issues. C, a letter of credit. Or D, a cosigner on the note. if it's not backed by less than 20%, the lender is likely to require the borrower to obtain subrogation agreement, private mortgage insurance, PMI, a letter of credit, or D, a co-signer on the note. The answer for 10 is B as in boy, private mortgage insurance, MIP. Anytime it's a conventional loan, not FHA or VA, and they're putting down less than 20%, then PMI is required by the lender. Number 11. What is a loan to value, TV ratio? What is an LTV versus portfolio that is composed of mortgage loans? B, the ratio of borrowed principal plus total interest to appraised value of the collateral property. C, the ratio of a lender's return on a mortgage loan to the value of the collateral property. Or D, the fraction of the appraised value of the property offered as collateral, which the lender is willing to lend. Loan to value. So how much loan is that lender providing on that property that's being sold? So let me see if there's any trigger words here. So it's not a ratio of borrowed principal plus total interest. Loan to value, right? So the answer is D as in dog. The fraction of appraised value of the property offered as collateral, which the lender is willing to lend. It's like, okay, you need to understand that. So the collateral is, let's say, 80% of the property, and which the lender is willing to lend. So they're willing to lend, making down 20%. So it's an 80% loan to 100% value, and borrow puts 20% down. Value expressed as a percentage is called the loan to value ratio, or LTV. If the lender's loan to value ratio is 80%, the lender will lend only $80,000 on a home appraised for $100,000. The difference between what the lender will lend and what the borrower must pay for the property is the amount the borrower must provide in cash as a down payment. I didn't know they were using the same example I used. So what did I say? The answer was D, right? Yes. Okay. 711D. Oh, you said the ratio of a lender's return on a mortgage loan? No. That would be like an ROI, return on their investment, a loan. So the ratio of a lender's return on a mortgage loan to the value of the collateral property. No. Their return is the interest rate. So they have an interest rate of 6 point something. Okay, so their loan with an interest rate of 6.5. That's their return. Okay, a ratio of a lender's interest would be the interest rate that they're earning on that mortgage loan. But the loan to value is the amount that they are financing to the value of the property. and they wait for the appraisal to make sure that the property appraises for the contract price for the contract that is in escrow. So the loan to value is 80-20, 80% loan, 20% down payment. So it's an 80% loan. That is the loan to value. It is not the value. Oops, not letting me move back. Okay, it is not the ratio of the lender's return on a mortgage loan. That would be the interest rate, the money they're making on loaning that 80% loan or 90% or whatever they're loaning, a percentage of the property value. Number 12. You knew it was collateral, but not which one. Yeah, so yeah, so collateral was on 3 of them. Ratio of borrowed principal plus total interest to the appraised value. No, that's not a loan to value. It is the collateral property. However, ratio of the lender's return, that is not loan to value. Okay. Loan to value is how much is the lender loaning? What percentage are they loaning on the value of the property's appraised value? Number 12, the difference between what a borrower has to pay to purchase a property and the amount a lender will lend on the property is A, mortgage insurance coverage amount, B, lender's profit margin, C, buyer's down payment, or D, origination fee. So the difference between what a borrower has to pay to purchase a property is insurance coverage, B, lender's profit margin, C, the buyer's down payment, or D, origination fee. So the lender is going to pay 90%. The borrower's difference amount is 10%. The borrower's down payment. So the difference between what a borrower has to pay to purchase a property and the amount of property. That's the loan to value. So it's in this case a 90-10. I said 90% is being loaned. So the buyer's down payment would be the difference. So price less loan is the down payment. This is also the buyer's initial equity. All right, number 13. Almost got it. Oh. No, it's going to be small. Let's see if I do this. A, ECOA prohibits a lender from doing what? A, refusing a loan because the borrower does not match the lender's target market. B, including income from self-employment in the borrower loan application form. Or D, refusing a loan because a borrower has a defective credit history. So the ECOA prohibits a lender from (713) Oh, the internet's a little slow because it's barely showing. That's why your answers are a little slow, Max. Okay, so 713, you're probably already answering it, is A. Refusing a loan because the borrower does not match the lender's target market. Okay, so they're discriminating. 713A. A loan applicant has an annual gross income of $72,000. How much will a lender allow the applicant to pay for monthly housing expense to equity to qualify for a loan if the lender uses an income ratio of 28%? So annual gross income of 72,000 and an income ratio of 28%. Right? So we're looking at gross income and the lender monthly housing expenses. So we need to know, first of all, how much money they're bringing in monthly, right? So we're going to divide 72,000, take it from annual to monthly, divided by 12, which will give us 6,000? 72,000 divided by 12, 6,000. 6,000 times 10 is 60,000. Yes, okay, so it's 6,000 per month. And then their income ratio that they're allowing is 28%. So out of that 6,000, we multiply times what? 28% the lender is allowing towards housing expenses. That doesn't include the mortgage. Okay, so 28% of 6,000, 72,000 divided by 12 gives us 6,000 times 28%, 0.28. So 6,000 times 28. So a quick way that I would do it is to round off the 30 to 3. 3 times 6,000 is 18. So it's not 840. It's not 1,000. It's not 2,100. Oh, it's going to be 6080 because it's a little bit less than 30%. That's the way I would look at it, right? Round off to single digit and then see where the number fits closest to it. So 714 is B, 1680. Does that make sense? Do you follow how I calculate it? So you've got to remember we're dealing with annual here and we need monthly. So we need to convert to monthly income. That's the first step. So it's a two-step process to this equation, to this problem. Number 15. AMC Bank discovers in considering buyer Bob's application for a mortgage loan that Bob has borrowed the down payment from an uncle and has to pay the loan. Bob should expect that AMC Bank will A, refuse the application, B, adjust the applicant's debt ratio calculation and lower the loan amount, C, increase the loan amount to enable the borrower to pay off the loan to the relative, or D, require the borrower to make payments to an escrow account for repayment of the relative's loan. Would a lender really do that? So the answer here for 715 is the lender is going to adjust the applicant's debt ratio calculation and lower the loan amount. Since he's got a higher debt, then he can borrow less money. So lender is not going to increase the loan so that they can pay off the relative because they have no collateral for the relative's loan, right? Remember, they've got to have collateral to protect their investment, to protect their loan. Require the borrower to make payments to an escrow account for repayment of the relative's loan. No, again, they don't have collateral and they are not responsible for him paying his uncle back. That's the borrower's money. So they're going to get less money available due to them. Okay, that's it for tonight as far as questions, reviewing all the finance questions on finance. I believe there's like 50 some odd questions on here. So I will be doing finance for another 2 sessions. Yeah, so the last question is 752. So we will do 2 more sessions of finance, probably 15 on another one. That'll make it 30, and then 22 in another one, give us 52. Or I'll split the remaining balance into 2 sessions. But anyway, we're going to have 2 more sessions of finance, unless I would get long-winded and do them all in one. We shall see. I thank you all for attending tonight and staying with us, and hope that you learned some valuable information and that you enjoyed reviewing the material for finance, and that it brought to your attention certain things that you might not have been aware of or remembered, and practice some of the questions. So tomorrow will be another session, and tomorrow we will continue finance problems so that we can end up finishing all the finance problems and then go to the next chapter or the next section. So I appreciate all of you being here, and I hope that my style of tutoring or reviewing works for you. Obviously, to some extent it does for those that keep attending. If not, you can watch the replay and play it on a faster speed if my vocabulary is articulate enough for you to understand it as you play at a higher speed, which I do a lot, 1.5. And for some people that I listen to on YouTube, I even go to the 2 times speed, and I can still understand them. So if you have any questions or have comments or suggestions, hey, put them in the chat. You know, after the video is complete, the chat results, okay, the chat replay will show up about, I think, 12 to 24 hours after this video ends. So if you don't see it right away, that's why. It has to process it, and it takes 12 to 24 hours, and then you'll be able to see all the written answers. And if you're interested in the book that I use, it's the blue book, and the link from Amazon is in the description that you can purchase the book. Even though it says Texas, they have books for many of the states, and you can purchase your particular state. The questions may not be in the same order as I'm doing, or they might be, because national is the same for all 50 states, and so is the math that they do. The only thing that would be different for you are the state questions. And you can also go to your state to review your state real estate commission also has questions in there. Then you can go and review. Here in Texas, there are hundreds of questions in our Texas Real Estate Commission that you can go in there. It doesn't have multiple choice. It has a question and then gives the answer. And any questions that you have about your real estate, just go to the Real Estate Commission to make sure you get accurate answers, or call them. They are there to help for questions that you might have, or email them. I've done all of the above. So use your resources and ask lots of questions. Don't assume, ask a lot of questions. Research it on the internet, Google it, find answers, research on YouTube. And there might be other channels. I'd love for you to stay on my channel only. However, I know there are many other instructors that review national and also states. So some channels review 50 states, and they don't go into detail, but they review a lot of questions. And they give you the question, the letter answer, and sometimes a little bit of a description. So, research, be resourceful, because you need to be resourceful, very resourceful once you become a realtor. Lots of questions. That's what we have to do in order to learn and understand what our borrowers or our sellers need, or investors. So continue learning until you pass the exam, because the big challenge comes when you become a realtor. You'll probably forget a lot of the material that you learn. You're going to learn it as you join a real estate brokerage and they have their own training, or you join a team. Sometimes it's worth joining a team and paying a higher percentage of your commission, but they provide everything. They do the transaction coordinations, they do the contracts, the listings, they follow up with the clients and stuff, and you deal with the sellers and the buyers. You pay a price for that. However, when you do it on your own, you have to pay a price for that also. That comes out of your commission. So you've got to look at the pros. You'll learn a lot from a team, even though they take a percentage, but you have to evaluate them. Ask a lot of questions when you interview companies. Okay. Again, thank you so much. I am an active realtor, and here in San Antonio, Texas. This is Lillie Handy Dominguez, and coming to you from San Antonio and YouTube. I've changed the name to not just YouTube Agent Prep, but Lillie Handy Dominguez and Agent Prep. So you guys, I appreciate you. I love you. I wish you the best. Keep studying. Thank you so much. Until next time. Until tomorrow. There's a lot of videos on my channel to help you with national vocabulary and Texas state.